Good afternoon, everyone. Thank you for joining us for today's webinar series, where we will cover ProntoForms. The company is listed on the TSX Venture under the symbol PFM. My name is Babak Pedram at Vertus Advisory. I'm joined today by my colleague, Corey Cohen, and of course, the CEO of ProntoForms, Mr. Alvaro Pombo, and CFO of the company, Mr. Dave Croucher. We will take approximately 20 minutes to walk through the investor presentation and then open the floor for questions. Should you have any questions throughout the presentation, please feel free to send them using the Zoom Q&A function found in the bottom of your screen, and we will make sure to get to them at the end of the presentation. If you have dialed in by phone and have a question, please send your questions by emailing us at info@vertusadvisory.com. With that, I will hand over the call to Mr. Pombo, the CEO of ProntoForms.
Thank you, Babak. Can you hear me well?
Yes.
I assume you said yes. Okay, good
Perfect.
afternoon, everybody. It's a beautiful afternoon today in Ottawa. I'm in Ottawa, Ontario, nation's capital, and had a great opportunity to tell you the story about the company, ProntoForms. And let me tell you about the company. I mean, we've built a company that throughout the years has primarily focused on a large enterprise market. We started with medium and small business, and we learned a lot of lessons through that. But throughout the evolution of the company, we've been focusing on large enterprises. My DNA is totally on large enterprise. I was the CIO of a large telecommunications equipment manufacturer. Before of that, I worked for Exxon Corporation in field automation. So when you look at these things backwards, they make a lot of sense as you're building them, not necessarily. However, we have a great recurrent revenue model that is compounding growth as time goes, and it's a good story, as you will see. So what is driving this story in the field? It is primarily 4 different elements. People call them digital transformation, big word, big name. Let me be more precise about what that means in the field. People in the field required workflows for a multitude of reasons, and they require many of them. Equipment are complex. They need working instructions. They need a different set of instructions and processes and paths to achieve multiple outcomes in the field. Those outcomes are ultimately about customer expectations and customer satisfaction, as well as financing outcomes of being more productive in the field. But there are 2 more components that are increasing the amount of workflows required. Number 1, the change in demographics. In the field, there are younger and younger people every day, and they've dated, married, eat everything through a device, and you go and you tell them, and hey, you know what? You have to fulfill the following workflow with this clipboard. They don't even know how to spell that, okay? In addition to that, the field has a set of people supporting them. And those people in the field, they know their processes at the edge of the organization. That edge is also, I mean, very sophisticated in terms of knowledge of what they do, but there are no more Java developers in the world, and even less of them available at the edge of an organization. So the kind of technology that you need to deliver to them is something simple, something light, something fast that required no coding. Tons of technology now present in the field and more coming, and that's ultimately yielding this increase for these more workflows. Now, the elephant in the room, everybody asks us, so how about COVID? The good news about COVID for us, I think the good news is that ultimately there are more needs for each of those 4 drivers around COVID. Field people and essential workers are more pressure and required by these enterprises. And not only that, I mean, there are protocols, there's compliance, there are big effect on how they perform that work in the field, and instructions and different processes have to change. So we're seeing no end in sight on the demand of these workflows. If you try to describe where we're at, I mean, what are we? We're ultimately a field-centric platform that enables those technicians to be more effective. So where in the world this fits? I mean, Gartner describes it as an LCAP, low-code application platform. We're part of their Magic Quadrant. But again, low-code application platform is the way we deliver the service. Ultimately, we're a field and I would say field worker-centric solution with that characteristics of being LCAP. Great reviews, great support, great acknowledgement of the great work we've been doing for many years. And if you are a little bit techie, I would like to explain you where are we in a stack of these solutions that are being built right now. We are enabling, as I said, those technicians, those operations behind them, and ultimately as well, the IT group that supports the stack that is what is required to deliver these solutions. This stack looks like what is on the screen. I mean, in the case of Salesforce, you have the Service Cloud, the Field Service Lightning. On top of that, we have a partner called ServiceMax, which nowadays delivers this Asset 360. On top of that, you have ProntoForms and these frontline workers. When you look at how these things are built, I mean, the goal of the automation right now is to deliver a work order totally end-to-end and ultimately get invoices back into the system, into the company. The next layer out as you reach this space starts to be around the equipment, since the ServiceMax and Asset 360, and around that is our place, the place where all these other workflows, contextually driven and sophisticated procedures to support these processes take place. Example of them, many, that's the good news, and we keep on growing them. Pacific Gas and Electric, Johnson Control, Philips Healthcare, examples of what we do in those cases when an MRI is being serviced by a Philips technician. Our product is being used when the majority of a boiler or an HVAC system is being used by Johnson Control. They use our equipment for multiple things, installation processes, instructions on health and safety, as well as operation or services. We process about 2.5 growing forms a month. That means 1 form a second. We have about 170,000 mobile users with 95,000 subscribers. So our business model is driven by 3 levers. Number 1, high growth subscription. Number 2, there is an operating lever based on strong gross margin. And the last one, a key one, is self-sustaining, because we're in cash flow break even. We'll talk more about that. And those 3 combined deliver a powerful financial model based on SaaS, I mean, on service, on software as a service revenue. Here's the path of growth. As you can see, we didn't come up with this yesterday. It keeps on growing, it keeps on evolving. Q2 20 obviously had a slight decrease due to COVID. From which perspective due to COVID? I mean, there are some customers, we have customers like airlines and others that their business disappeared, okay? However, there has been a strength and a strength that continues to be shown in our numbers from all the other customers. However, I mean, the world came to a halt, and the good news is that people kept using the product and continue to evolve the usage of it. This slide is about, we started our business selling these forms and these workflows to small businesses through AT&T and other operators when they were selling these iPads. The reality was that very early in the game, we started to listen to that enterprise signal, as I said at the beginning. And today, more than 38% of our base and growing it consists of enterprise accounts. Enterprise accounts that keep on evolving in a great way, as you can see in the graph. Those enterprise accounts, I mean, I always said that if someone can show you a good description of what their business is like, it's this one. I mean, you see those cohorts, and those cohorts on the upper part of the slide, you can see how the number of customers, the recurring base, and the expansion that we derive from them. As you can see, that third line, those customers over $100,000 of ARR have a net retention rate of 122 and even higher some quarters. And look, I mean, that's the engine of growth of the business. The other one is a good, sustaining business, the commercial business. But as you can see, those cohorts continue to expand throughout the years. This is an example of a large customer that we have, and I just want to illustrate how these accounts grow, because the product has a characteristic. I wish I will have the name for it. We call it expansion, but it's an expansion that within those accounts, it takes off in a great way. And this is an example of that. I mean, we started with this large heavy equipment manufacturer in small deployment in North America. Soon after, something happened in Hong Kong that they needed this product. Right after that, North America evolved to a very large, that's this gray balloon in the middle of the graph. And then you continue to see the evolution, and we still have more to go. This has been a terrific customer, multiple use cases, and the last gray bubble there is the product is being used right now throughout North America for some COVID related issues in a great way for about 12,000 people, okay? So as you can see, these things evolve, they continues, and there is definitely the land and expand on it. And obviously we fine tune our behavior and our sales cycle towards that. This is another one of those examples. You can see our top 20 customers. Blue is when they started, yellow is when they added a significant amount under $100,000. And then green, you're looking for green and dark green. As you can see, the process is getting shorter and we're getting to larger numbers in a faster way. That is what we all want to see. I'm going to let Dave connect the dots of that financial model that I referred to before and the different leverage with our financial reality right now. Dave.
Okay, thanks, Alvaro. Yeah, in terms of the financial model and the operating leverage, we have a couple of things in our favor. Number one is the growth. So if you notice the slide earlier, we had 27% annual growth in 2019. And that growth helped us reinvest. So as we grow, we can reinvest that growth and just keep compounding that. And the idea is that we keep the whole thing cash neutral, but reinvest in the business and grow out and add to our sales resources. So we've been able to do that even in this year during COVID. We've added a fair bit of strength to our sales team. So now we have 20 producing or quota bearing reps, and we have another 25 people around that in terms of management and operating support, technical people like client directors and sales engineers and that. So we have what we feel is a pretty good group that's been built out, and that's going to give us more opportunity for growth. And early in the year, we saw a dip, March, April, May, but we did see that coming back in June. So that was very encouraging. And now that we have that group that's in there and stable, as people get back to business and start opening up the purchasing process, we are seeing some progress there. So that's the idea, is that we reinvest our revenue growth back into go-to-market. So you can see the blue lines here are pretty, the sales and marketing is fairly high investment. The other areas of R&D and G&A have been coming down as a percent of revenue. There's still a fair bit of investment in R&D, but as a percent of revenue, it's been coming down, steadily decreasing. So just switching to the next slide. So you can see what that means. So here's the example. So we had 11% growth in 2017 up to 21 and then 27, always very strong margins throughout. We have non-GAAP op loss through most of those periods, which is our form of EBITDA. We're really just adding back stock-based comp to the calculation. But you can see that even better than that EBITDA measure is our operating cash flow. And that's because as we add these enterprise customers, they're prepaying on their contracts, and that's ending up with very little operating cash outflow. So you can see 2019, we only had 2% outflow on that. And that is a big reason is the deferred revenue increase at the bottom, the 1.3 million. We did have a dip back in COVID times, but the good news here is that we can lever that expense back in those same periods. And then as we get back to growth, we start investing more in the sales and marketing, but also offset that with the prepayments. The other point I'll make is the cash has held pretty steady above US 5.5 million since June of last year. We had some warrants that were exercised, and that brought our cash balance up, and we've been holding that very steady throughout. Even though we've had EBITDA losses, our cash has remained steady because of that operating cash flow. This next slide.
So look, I mean, we have those three levers in the operating model: great growth, great customers based on enterprise with a high retention, and a very sticky amount of business processes that are not going away anytime soon. In addition to that, an operating margin that is that proves the model, plus cash that we can maintain the operation and continue to grow. Our profile of growth is, as Dave was describing, you can see the numbers in the high 20s, low 30s% of growth. And we have a business that continues to perform at that level. So behind the scenes, who's there? Management team, a strong group of seasoned people with different layers of expertise. We operate the company has a very strong culture, and culture that we all cherish and we all support. And we also have behind the scenes a strong board of directors. We've been public for 11 years now, something to that effect. We started definitely too early to be public, circumstances of survival in 2008. However, it has a very strong governance, a very strong structure, a very seasoned board that maintains the company in a great cadence of a strategic analysis, of delivery, of revenue, of different processes that guarantee, I guess, the well-being of all of us around, plus a very clear future that we are pursuing. So if I summarize what we have in our hands, I'll say, number one, we have a leading product in a growing mobile enterprise market. This is not an old product, it's a fresh product that continues to be innovated all the time with a set of dynamics in the market that demand more and more of them. Trust me, there is no end in sight with the amount of workflows that field organizations have to automate. The automation in the field has not happened yet. We are just seeing the early stages of it, and there is lots of productivity to be extracted and business reasons to do it. Number two, predictable and growing recurring revenue. I think we've talked about that, and a strong expansion from enterprise customers. There is still a little bit of revenue and some of the base in the small that's disappearing. Majority and the core of it is in the commercial mid-sized business as well as the enterprise side, and we've scaffolded the organization to support that kind of revenue. That is the revenue, those are the customers that we've been making the investments on, and it's translating into numbers. Cash flow annuity to build up a high customer retention rate, strong operating leverage, as I said, technology and go-to-market with some key partners, Salesforce, ServiceMax, different partners in our ecosystem. We've been around, they know us, they respect us, and we have very good relationships with them. And something that I believe we have, an untapped market opportunity that keeps on unfolding in front of our eyes in a great way. So that's all I have to share. I appreciate the opportunity of telling you more about ProntoForms. Sunny day, bright future. What else can you ask for? I will open now for questions. Babek, you decide what's next.
Thank you, Alvaro. That was great. I'll remind our audience that they can submit questions through the Zoom Q&A function at the bottom of their screen, or they can send us an email at info@virtusadvisory.com. Our first question pertains to the channel partner strategy. Can you guys expand a little bit about some of your channel partners and some of the successes that you've seen out of that approach?
Yeah, thank you, Babak. Look, partner is a big word, and I have a lot of respect for that word. It's something that takes a while to build up, and it takes, consistent investment to realize the benefits of it. I mean, we started partnering with AT&T in a great way. We know how to partner. We know how to do it. As the market has evolved, the market now has a different set of market makers. And I mentioned Salesforce, I mentioned ServiceMax. Those are very close partners of ours. We also have a substantial amount of integrators in that ecosystem. And these are, ultimately people that are supporting companies that are building these field services solutions. There are other partners in this ecosystem. There are some geographically oriented partners that help us expanding the footprint. But there are many more to come as well. When I look at the expansion strategy of the company geographically and in so many different verticals, those are two areas where you will see further investments of the company going into. Right now, the majority, there's a good part of the revenue that comes direct, but the partner side is not inconsequential whatsoever. And it keeps on growing, which is the good news.
Great, thank you. Our next question asks, is there anything you feel investors tend to misunderstand about ProntoForms or our business as a whole?
Good question. And I ask a lot of them similar kind of questions. I'll tell you what is happening. As time is going by, we started from a very small base, okay? So when you're very little and when you have revenues, we went public when we were $150,000 of ARR. That's very little. So it's a long way to take a company. It's been consistently high, 20s, 30s, but it's a small number to get to where we are. And there are thresholds for investors to sort of pay attention to things. But I can tell you, and if you can see it in the recent trading, the recent activity, is that people like it. I don't know, up to them to say if they love it. I do believe they like it, they buy it, they hold it. And that creates some challenges as well from a perspective of dynamics in the market. But I think the public market is building up in front of our eyes as well. And look, I don't work every day to move the stock market or the stock price. We work every day to build shareholder value. And it will be translated in that stock price throughout the journey. So it's hard to say what will they misunderstand about it. We'll see. I think that's a changing answer as we speak.
Great, thank you, Alvaro. Our next question is for either you or Dave. If you could expand a little bit on the churn rate as it relates to revenue, what's the historical churn rate been, and has there been an uptick or a decrease in these COVID times?
Anything that is churn related, I'll pass it to Dave.
I'll take it. We do have a mixed base just really because of where we came from and how we've been building up the enterprise side. The enterprise is very strong, very high net retention, which is, not only what did you keep, but how did you grow that base? And then on the gross retention, which is really just a straight up churn from the customers that you start the period with. So we're much better than any the benchmarks on the enterprise. We're maybe slightly worse than the benchmarks on the small business, which as we've been changing the product and changing our focus, you would probably expect that. But that's really been reducing in the last year or so. We did see in the COVID quarters, Q1 and Q2, we did see an uptick on the churn, mostly with small, medium business. And fortunately, we had some, well, in Q1, we had some delay on bookings, mainly enterprise, but at the end of Q2 in June, we did see an uptick there. So that really brought us back, and we think we're through the worst of it, because we did have a dip in the base slightly through April and May, and then we actually ended up in Q2 being above, which of course the net is, you take your gross bookings and then minus your churn. So we saw a slight uptick in churn, but a delay in gross bookings. So we feel like a lot of that's cleared out, and we're back to being in pretty good shape, and we think we're doing better than the benchmarks once again. So.
Great, thanks, Dave. Sticking with you, our next question states, at some point, I would assume sales and marketing will get smaller than about 50% of revenues. What would be next in terms of reinvestment opportunities? Would it be more R&D or possible M&A?
Yeah, good question. For the short term, or say the next 2 years, really what our focus is organic growth. So the go-to market, some products, some R&D, but more heavily weighted to sales and marketing. We feel like we've gotten to where we are based on those top 20 customers. We've had really nice expansion with those guys, and we have another 140 in our base that we feel could also expand really well. And we've been adding those resources to be able to, unlock that, and also go out and get new logos. And I think with what we've done so far, the first half of this year, we can keep adding to that. We've made a fair bit of investment, so we don't have to keep aggressively doing that. But I think we want to, keep the pace there so that we can get that growth and take advantage of the really good product that we already have. There's, a big event that we have coming up, Empower, which Alvaro is better to describe, but we have 500 people coming to see that. And, that's a really good testament, a lot of enterprise, a lot of, mix of customers, and just how that user community is growing and how we can keep that momentum going. I think anytime we look at making those investments, whether it be sales and marketing, R&D or product or acquisition, the objective is, or the idea is that we want to see whatever next dollar will give us the best return on that. So, and I think right now in this short-term phase, we feel that sales and marketing and probably some product, but more weighted to sales and marketing, can get us the best impact there.
Great, thank you. Maybe on that note, could either you or Alvaro expand a little bit on the Empower event and what that's meant for you guys historically?
Sure. Look, Empower is something that we started with just a customer council that evolved into 75 people came last year to Ottawa, from 75 customers anyway, to learn more about how to use the product, what other companies are doing, etc. So this year, in the COVID days, I think COVID for a company of our size has been a blessing. How else imagine you can portray and describe who you are, without having access to the CIO suites or the C-suites in a lot of those companies. And I think these virtual events, allow us to demonstrate who we are, demonstrate the capacity of the organization, demonstrate the personality of the place and the kind of vendors that we are, and that you can describe that to many people. So we started with this Empower event, which is going to be, a day of different presentations targeted to those three constituents: the end user, the citizen developer, and the owner of the tech stack, to describe what we do for them, and so they can hear from real customers, large customers, what is it like to deploy 5,000 subscribers in a month or in a week, and get some tips and tricks from reality of that. So I think it's going to be a very powerful event. It's not, we thought it was going to be like 200 people were going to show up. We're at 550 and counting. Tomorrow, I believe we're going to put a press release on it, and just everybody on the call, you're more than welcome to register. Come take a look firsthand of what we're talking about, and get just up and buy more stock. You will see some very good stories being told. Great,
thank you. Our next question is on the product side. product side, are there any technology gaps that exist that could be rectified by future R&D spend over the coming year?
Look, I'll take it straight. I mean, I'll describe what the product, number one, the product, what we started the company with, there wasn't any major pivot, but we basically rebuilt the product around 2012 based on a totally brand new platform. There's not a single line of code of the product that we started with. However, I mean, we never had to pivot. That's great news about the company. So this new product, I mean, it's very fresh, very modern. I mean, with all the buzzwords that you can imagine, they're there. And those buzzwords and that youth of that product, what it guarantees you is that you can still attract young guys out of university who are excited to come and work with ProntoForms because you have a leading edge technology supporting a growing story. So that's number one. So I believe, I mean, that the way we're building the product, I always describe it like, how do you fill a jar with stones, and you can put 2 rocks and tons of pebbles, okay? And that's how we do and how we look at how we build a jar every year. So there are usually 2 big things that we do, most of them, and I will tend to say all of them, with a large customer attached to it, okay? And they pay for it and they help us financing it, all driven by real customer requirements, no scientific endeavors here trying to be too cute, and a lot of little enhancements. So it's a very dynamic product, and I don't see that we have a major thing to do. Now, as we evolve the product vision and as we become that frontline worker platform, sure, there will be room later to do some talking acquisitions, bring a little bit more of technology acceleration in certain points, but not because we're behind. I mean, the opposite. We've been too early, and that's been the story of my life. What we're trying to do right now is to pace it with the market demands, or not right now. That's what we did for the last 8 years. Now we're at the right pace, and I believe we're satisfying the customer needs in a great way.
Excellent. I will remind our audience that they can submit questions through the Zoom Q&A function at the bottom of their screen. So we'll just give it a minute here for any last minute questions. Okay, Alvaro, it doesn't look like anything's coming in here, so I will leave it to you for some closing remarks.
No, I mean, Babak and Corey, thanks for putting the event together, and we're open to continue these conversations offline. If anybody wants to reach out through you or directly, we're always happy with Dave to talk to new investors and existing investors about their views or, I mean, their assessment of the company. I honestly believe that this is a great time in the company's evolution. And I will just say, if you're not a shareholder, keep an eye on it, because there is definitely a good story evolving right in front of our eyes, mature, steady, nothing wrong with it whatsoever.
Excellent. Thank you so much, Alvaro. Thank you so much, Dave. On that note, Alvaro, I will ask you to end the webinar.
Thank you all.
Your screen. Thank you.